One of the important features about liabilities is that they have the ability to help create financial leverage. And financial leverage is a way of using liabilities to create value. So let's look at how this works. First of all, financial leverage is similar to physical leverage. And physical leverage was first described by the Greek philosopher Archimedes at about 350 BC. Archimedes is famously said to have stated, "Give me a place to stand and a lever long enough and I can move the world." And of course, physical leverage works through the mechanism of using a lever to focus force. Lever and a fulcrum, and you can see that's what Archimedes is doing here with the world. You're focusing the force that's being applied to moving an object. Financial leverage is essentially the same principle. It involves using financial devices, in this case liabilities, to focus the value-creating force of the company. Let's see how it works. So financial leverage involves the efficient use of financial resources, and these resources of course are assets, liabilities, and equity, and involves freeing up owners' equity, which is at the end of the day an expensive economic resource. Because it's risky, owners demand a high return on equity. Liabilities typically are less risky to the issuers or to the owners of the liabilities than is equity, and therefore less expensive. Also, as we know from our readings, liabilities are subsidized by the government. There's no need for payment of taxes on interest associated with liabilities. Equity, on the other hand, is not subsidized. Dividends paid to the owners of the company are not tax deductible. Okay, so we're using other people's money, OPM for short, to derive benefits from financial leverage. And last, financial leverage can accelerate value creation. Okay, businesses, as we all know, exist to create value. That is the principal goal of every business. So value is created when the return on investment, that is the return that the owners get for the money they invested in the company, exceeds their cost of capital. So we can find the amount of value created as the return on investment minus the cost of capital times the investment. Okay, so let's start with a first case, a company with no leverage whatsoever. That is, the assets of this company are funded 100% by stockholders' equity. So I've created a simple balance sheet here. We've got $100,000 of assets. We've got $100,000 of stockholders' equity. If net income is $20,000, then our return on investment is 20%, which is $20,000 divided by stockholders' equity of $100,000. So 20% return on equity. So if the cost of capital of this company is 15%, we'll use our formula to determine if they created value. So 20% was the return minus 15% cost of capital times the $100,000 of stockholders' equity or investment gives you a value creation of $5,000. Not bad. But now let's take another case where we apply leverage. So in case 2, we have a balance sheet that's identical in every way to the balance sheet in case 1, with the exception of using $10,000 or $50,000 of notes payable to finance our assets in case 2. So if we have $50,000 of notes payable, that means we only require $50,000 of stockholders' equity. Okay. Now the notes payable have a cost of 10%, And if we assume the tax rate is 40%, the after-tax cost of that note payable is $3,000 per year. That is 10% times $50,000 is $5,000 of interest expense, less the tax benefit at 40% of $2,000 that we get for being able to deduct that interest expense. Okay, so the after-tax cost is $3,000 for that note, which reduces our net income by $3,000. So instead of $20,000 of net income, we now have $17,000. Okay, so our return on equity in this case is $17,000 divided by $50,000 of stockholders' equity, 34%. So let's talk about value created in this case. So our return on equity is 34%. Our cost of capital is still 15%. This time we only have $50,000 of stockholders' equity, so we have $9,500 of value created. In case 1, we had $5,000 of value created. So we created an additional $4,500 from leverage in this case. And we have $50,000 left in our owner's pocket that they can invest in something else, which is another benefit. And that is financial leverage.